Tech Mahindra's Q3 FY24 results digital press conference. We hope that you and your families are keeping safe. Before we begin, I would like to inform you that there will be an extended Q&A session at the end of the conference. Today we have with us on stage Tech Mahindra's Managing Director and CEO, Mohit Joshi, and Chief Financial Officer, Rohit Anand. Without any further delay, inviting Mohit to the podium.
Thank you, Abhilasha, and thank you all. Good evening, and thank you all for having joined the call today. And I start by wishing you all a very happy 2024. As many of you know, I joined the company about 7 months ago, and I've used this time to travel the world, to meet all of our clients, to meet with our teams. And I'm very grateful and privileged to speak to you today as a leader of this wonderful organization. From all the sessions I've had, the meetings I've had, I found that it's an organization that is respected by clients for the quality of the services and the caliber of our talent. We have embarked on a turnaround phase in TechM's evolution, and we are actively making foundational moves to upgrade our performance. The overarching goal that we have in this phase is to make the investments and the changes to maximize our long-term earnings growth, to drive a culture of performance in both delivery and in sales. As we shared previously, we're in the process of defining our long-term strategy, which will then be effectively implemented to give the long-term value for our customers, for our employees, and for our shareholders. In the previous earnings call, I had shared the fact that we are embarking on 3 tracks to unlock the value from our operations. The first track is for sales improvement, or the revenue growth track. The erstwhile organization structure at TechM, comprised of 12 sales SBUs, which we have now simplified to just 6 units. We have also eliminated the dotted lines. We have delayered the hierarchy for better synergy and for accountability. The portfolio companies are also being integrated under the respective business units for better realization of the synergies. We also scanned through our portfolio and we saw a need to reconsider how we allocate time and investments across our overall client portfolio. What we found was that there was a low investment focus on our top accounts, and I think this has resulted in our not realizing the true value of these very significant clients that we have. At the same time, we have found ways to substantially improve and to better utilize our efforts in engaging across the smaller clients as well. So, in a nutshell, we are bringing more attention and investment to the top accounts, and we are revamping our efforts to engage with the smaller accounts. These actions are going to improve the effectiveness and the efficiency of our sales efforts. So that's on the overall revenue plan. The second track that we shared is for margin improvement. Historically in TechM, as the delivery teams were aligned to the regions and they were spread across too many units, there was a lack of central ownership, leading to a lack of scalable, innovative, and industry-focused solutions. We have now moved to a centralized delivery structure for IT services, which helps us foster innovation and domain expertise, but also helps us implement focused programs directed towards cost reduction and margin expansion. In my 7 months over here, I found that at TechM, the quality of the delivery talent is very strong, and our staff really have an intense desire to serve clients. By combining this strong talent pool that we have, which significantly improve delivery structure and processes, I believe that TechM will further enhance its client service while also increasing our innovation, profitability, and scalability. In addition to the plan for revenue and a plan for margins, we are also working on a plan for reorganization. TechM historically has thrived under entrepreneurial growth, and this has fostered an informal culture. The intention now is to combine this agility, but also to take a look at the frameworks and to make sure that we're able to implement changes and to move quickly. The organization structure over time had become hierarchical and siloed, and I truly believe that a company of this size needs robust processes and frameworks. So there is room for freedom and for creativity within the set framework. We've made changes to our internal policies on these lines, and there is a lot more work that is happening in these areas in the months to come. For an organization which is as big and as diverse as TechM, I think it's important to progress from an entrepreneurial model into an organization with a unifying vision and supporting frameworks. We have also just recently concluded a cultural assessment using an independent assessment firm. And the final report has identified an encouraging set of cultural strengths. And these strengths, as you can imagine, are around customer centricity. They are around a sense of belongingness and a pride in the company's heritage, in the group's heritage that we have seen. But the studies also highlighted some areas where our organizational practices need to improve. And in that regard, the key improvement opportunities really include elevating the roles of our delivery organization, which I believe that decentralization will help put that into place. It has also identified the need for improving the consistency of our associate rewards and the consistency of our feedback processes. So based on these inputs, right, and these inputs were a set of surveys, detailed focus group sessions, the collective feedback of our leaders, we are working towards establishing and really building on the culture of the company, building a further culture of performance, a culture of professionalism, learning, and merit. We have already started making changes to our incentive schemes and to our HR policies to reduce the bureaucracy and to empower the workforce. And I believe that by diligently embarking on these three priority areas, right, the plan for revenue, the plan for margins, and the plan for the organization, I'm very confident that we have all the strengths that it needs to pull off this plan. As I have repeatedly said, the strengths of the company lie in our talent pool, in our client base, and the very strong heritage of the company and the very strong heritage of the group. We are a market leader in CME and in manufacturing, and I believe we have strong emerging strengths in banking and financial services, healthcare, life sciences, and retail. We have a fast-growing BPS business, and we have distinctive capabilities in IP, in engineering, and in AI. So I believe that we have the foundation, the merit, the talent, the values, the ability to achieve all our goals, and I don't see any hurdles that stop us from becoming really the best technology services company in this space. So building on these strengths, along with the focused efforts on the areas of improvement that I mentioned, we're embarking on a turnaround effort that will take TechM to the next stage. The primary objective of this turnaround effort is to maximize TechM's long-term revenue growth and long-term margin. Doing so will require substantial changes. It will require some turnaround costs and above normal investments over the next year. And to underscore this, especially given the multi-year opportunities we see, we will use this turnaround period as an opportunity to invest to significantly improve our positioning in a set of target markets. We've also worked to onboard a significant set of leaders, and the previous quarter was, in a sense, a quarter of new beginnings. Richard Lobo, as you know, has joined us as our new Chief Human Resources Officer. Rajshri has joined us as the Chief Growth Officer for the Americas Strategic Verticals. Piyush Dubey has joined us as the Chief Marketing Officer. I had already previously announced the joining of Atul Saneja, our Chief Operating Officer, Roshan Shetty and Pankaj Kulkarni as our BFSI heads in the US and Europe, respectively. In addition, we have also strengthened the leadership to scale the BFSI vertical in Asia Pacific and the ANZ region. And I want to take this opportunity again to welcome them to Tech Mahindra. They are significant additions to the team, and I'm sure that they will bring great value through their rich experience and domain expertise. I believe that we already have a great team in place at the helm, and with these new additions to the TechM family, we should be able to take this organization to the new heights from already very strong foundations. So now moving on to the Q3 results, we report revenue today of $1.573 billion for the quarter ended December 2023, which is a growth of 1.1% for the quarter sequentially, and a decline of 5.7% on a year-on-year basis. As we look further into the segments, the growth in the quarter was mainly driven by our strengths in the manufacturing sector, where we continue to leverage our history and our deep expertise in the automobile and related ER&D services. We are also seeing an uptick in the retail segment during the holiday season, and that played out this year as well. Outside this, most of the other segments like CME, like BFSI and high tech were impacted by furloughs. We have reported EBIT margins for the quarter at 5.4%, which is an expansion of 65 basis points. These numbers are the outcomes of actions that we have taken to de-risk the portfolio. Once you adjust for these exceptional items, the operating margin stands at about 7%. We report new large deal wins, TCV, at 381 million for the quarter. This comprises of deal wins across our key segments. And just to give you a few examples, we were selected as the strategic IT transformation partner by a prominent life and annuities provider in North America. This is a large, multi-pillar, comprehensive transformation engagement that includes the modernization of the core through cloud migration, application services, and infrastructure services. TechM was also selected as a strategic partner by a US-based telecom OEM for building and operating their next-gen state-of-the-art lab in Plano, in Texas. We were chosen as a partner of choice by an American package and supply chain company. The portfolio transformation deal includes a scope of work across application development and maintenance, enterprise applications, cloud, next-gen data analytics, AI machine learning, as well as digital design. Tech Mahindra has also been selected as a prime services partner by a US-based telecom operator. TechM will provide transformative design, development, management, and support services for the ILEC stack. We have been selected by a large Asian bank for a comprehensive digital banking CX deployment servicing their customers in the region. So you see a range of wins across geographies and across vertical areas. Just to spend a little bit of time now on the progress that we're making from an AI perspective. And we have seen significant progress on the Gen AI front. We launched the Vision Amplifier, which is a solution which infuses Gen AI and computer vision. It provides an end-to-end workbench to substantiate computer vision use cases. Earlier, we had launched the Email Amplifier and our Ops Amplifier. So this is our third offering in the Amplifier suite. We currently have active client conversations related to Gen AI, and we see early-stage experiments and POCs now starting to move into production pilots. Many of these engagements are in the areas of conversational AI, document AI. Gen AI, as you know, is an integral feature of large transformational deals as well. And we have also seen standalone Gen AI deals. These are in areas as diverse as enterprise knowledge search, customer engagement, business process management. In terms of industry segments, healthcare and life sciences, stands out for me as an early adopter of Gen AI. I think we are seeing specific interest in areas like drug discovery, EMR, and medical audio scripts. We're also helping hyperscalers and SaaS providers to scale their AI offerings. We see the emergence of complex use cases of Gen AI applications in areas like chip design. And to maintain our lead in this space, we will continue to train our associates with Gen AI-led skills. And we intend to enable this for 100% of our talent base. Currently, we have trained over 16,000 associates, and the coverage will increase as we move forward. This is for pair programming. Much larger number of people have broader Gen AI and AI training. Finally, from an awards and recognition perspective, I'm happy to announce that Tech Mahindra is the only Indian company to make it to the Dow Jones Sustainability Index, the World Index 2023, part of the DJSI World Index for the 9th consecutive year. We've also been recognized as among the progressive places to work in 2023 by ET Edge. Now, having given you the broad general overview, I want to hand it over to Rohit to share an update on the financials. Over to you, Rohit.
Is it audible now? Okay, thanks, Mohit. I'll just share the financial results in detail for the quarter. So we ended the third quarter with 1.573 billion US dollar, which was up versus last quarter by 1.1%. When you break it down into comms and enterprise, communication vertical declined by 0.3%. Enterprise grew by 2% on constant currency basis. When kind of look at this growth, we had certain one-time revenue in the quarter because of which we got some upside. If you normalize for that, we are flat versus last quarter. We did have some positive impacts due to seasonality in retail business and our Comviva business, which was offset by the negative impact we have at year-end due to furloughs. In terms of large deal wins, our TCV wins was at $381 million. From a margin and profitability perspective, we ended up at $84 million US dollar at EBIT level, which was up from 73 million last quarter. The margin percent hence was 5.4%, which was an expansion of 65 basis point QOQ. As we mentioned last quarter, we continue our journey on looking at the portfolio, rationalizing certain businesses where we don't want to be long term. Based on those actions, if you normalize for that impact, our EBIT margins at the quarter is at 7%, similar to the normalized margin last quarter. Moving below EBIT, our other income for the quarter was $11 million US dollar, which was down versus 32 million last quarter. Forex losses was 5 million versus break even. We either had a loss or a gain last quarter. In terms of ETR, we were at 22.8% this quarter. We made the PAT at 61 million US dollar, which made the profit margin at 3.9%. In terms of free cash flow, we had a great quarter. We declared 228 million of free cash flow, which was 2 consecutive quarters of more than 200 million of free cash flow. When you look at the DSO improvements, we saw 6 days of improvement in the quarter, which got our DSO down to 91 days. We do expect the cash flow conversion to normalize in next quarter, but for the year, we'll still be looking at a very healthy cash returns. In terms of the hedge book, we ended the year December 31st at a 2.3 billion hedge book versus 2.5 the previous quarter. As you know, we follow the hedge accounting policy based on that. At a mark-to-market gain was around $5 million US dollar. 2.8 of that is taken to the P&L, the rest goes to the reserve. We stand at cash and cash equivalent of 843 million as of 31st December, which is healthy from a balance sheet perspective. And as mentioned earlier, we've taken a series of action this year from Q2 and Q3 from our portfolio, both on the top line and bottom line. And result of these actions are resulted in a lower reported earnings, but we are pretty confident that as these actions give us long-term benefit, you will see the return of that in the future quarters and years to come. So we now open to take questions. Abhilash.
Thank you, Mohit and Rohit. We will now conclude this stream. For those who have joined us on social media, thank you everyone for joining us. We will now open the conference for